So now let's look at a couple, again, historical patterns where that gap got really wide. And spoiler alert, you're not going to like how either of these end up. So now, this is the early 2000s. I'm going to put in that natural rate of unemployment. At that time, it was around 5.2%. April 2000, the unemployment rate was 3.8%. That gave you a gap of 1.4%, so greater than what we have right now. What followed that was the 2001 recession. It was a relatively shallow recession. It wasn't really the recession that was the problem. 8 months minus 0.3% is not that deep a recession. But the real problem is what happened with the market. The market fell almost 50%. Of course, this is the famous dot-com bubble. So that gap helped create this asset bubble. The next one we're going to show is in the late 60s. Again, we're going to put in that natural rate of unemployment, still 5.2%. And March 1969, the unemployment rate got down to 3.4%, the gap of 2.4%. So even wider. What followed was the 1973 to 75 recession. This one was a deeper recession. 16 months, the economy shrank by 3.6%. But this is the key. Unemployment, or rather, inflation got up over 12%. So you had a very stagflationary environment, a very bad environment for investing and for the economy. And also the market went down 45%. So again, not a good result, and something the Federal Reserve is very wary of and definitely wants to avoid in the future. So they've got a lot of things they're going to look at in order to make their forecast. But because of what happened in those two examples, they're going to be very cautious on this, which I think is very important, which is inflationary expectations. They want to anchor it around 2%. And they were very wary of inflationary expectations moving significantly higher, or you could get back to a stagflation type environment. The concern is lately they've talked about maybe letting it run a little bit hotter. Because it's been running less than 2%, maybe we can let it run a little bit more. And we think that could be very dangerous. And the Fed, into their defense, they have a bit of a balancing act because they don't want to raise rates too quickly, otherwise they'll cause a recession sooner. But if they wait too long, yes, they can delay a recession, but it could be a worse recession down the road. And it's hard for us to forecast because we don't know what the Federal Reserve is going to do. And quite frankly, we don't even know who's going to be making that decision. And we don't know if Jerome Powell will lose his fight with Donald Trump. So we kind of feel like Steve Carell in The Anchorman. When you make a forecast, it could be 60 degrees and sunny or maybe snow. So a wide variation in how that might turn out. Longer term, an issue that we're focused on and we're worried about is debt. And debt is a global issue. John's going to talk a bit about consumer debt in Canada. Tonight, I'm going to talk about more of government debt in the US. And we call it the inconvenient truth because the real inconvenient truth, of course, is global warming and the role fossil fuel plays in that and the inconvenience of dealing with the problem. And it's the same with debt. In the US, the Congressional Budget Office is estimating the US budget deficit over the next 10 years is going to be at $1 trillion a year. This is an extremely dangerously high level. Social Security and Medicare is right now about 40% of all federal spending. It's estimated by 2029 to go up to 50%. So the problem is an aging population and the obligations the US has for their entitlement spending that needs to be dealt with. So that, that's going to be a problem going forward. But to make problems even worse, and I'm going to show this next chart, the Trump tax cuts makes this issue even worse. And what this chart is showing you, the white line is the unemployment rate, the yellow line is the budget deficit as a percentage of GDP. They normally move in tandem because when the economy is getting better, it means unemployment's going down, the budget deficit should be going down. And that typically is what happened. Here you can see the unemployment rate going down, but look, that yellow line moving higher. It means the budget deficit's been going up because of the Trump tax cuts. When have we ever seen that situation before? Well, unfortunately, it was the late 60s. So again, leading up to that stagflation environment. Again, not a very good historical pattern to follow. Jeff Grunlich, who is considered the new bond king, a big fund manager in the US, points out the last 7 recessions, the budget deficit increased about 4%. But the last 2, you've seen the budget deficit increase considerably more. Because you're starting from a high base, he thinks in the next recession, the budget deficit's going to increase by 13%. So a big problem that needs to be dealt with. And it's a problem that unfortunately keeps getting kicked down the road. And we think that eventually the market's going to kick back. Namely, we think, and our concern about this is that in Washington, there is a bipartisan lack of interest in dealing with that. Nobody's talking about it, and they need to. The Republicans, they don't want to deal with it because they're worried that if you do anything with this, it's going to curtail the tax cuts that they're so proud of. Democrats feel that it's going to impinge social spending like entitlement benefits. Now, if you're thinking that Donald Trump is going to deal with this, the king of debt, you're sorely mistaken. Because in a Washington Post article last year, a conversation between the president and some of his senior advisors took place, and a hockey stick-shaped chart of the growth in debt was shown. And Trump's reaction, yeah, but I won't be there. And that is the problem. Nobody wants to deal with it, and eventually it's going to be a problem, and the bond market and the markets are going to have to react accordingly.